Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is eBay, ticker EBAY. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, we have a market cap of $24.9 billion and an enterprise value of $27.9 billion. So you see about $3 billion in net debt, which is really only about 10% of the enterprise value, which is pretty low. The internet and direct marketing retail industry. So eBay is a marketplace platform that connects buyers and sellers in the United States and internationally. Its platform includes online marketplace at ebay.com as well as a suite of mobile apps. Users can list, buy, sell, and pay for items for the various online resources, has auctioneering, commerce, participants, shopping channels, networks, various things like that. It was founded in 1995. So ebay.com is something I've heard of, certainly. It is a marketplace type business that tells you a lot about what they're trying to do. They are having network effects. They have to have a two-sided network of buyers and sellers, and they likely take fees for making those transactions. The beta of 1.25 tells us it's slightly more volatile than the average S&P 500 company, but not significantly so. Now let's look at the return on invested capital chart. This is a really hard chart to read because something crazy has happened in the last 2 years. Look at this. You basically are running at 9%, 10, 11, 12, 10, 3%, 14, 18, 11, 17. There's actually quite a lot of change in this area of the graph, but you can't see that so much because of this last few years of numbers. In 2016, you go up to 44% return on invested capital. You lost money in 2017. It's the only year you lost money in the last 20 years, which is actually really, really good. 19 years of profits out of the last 20 meets my threshold for what I would consider a quality company. In addition, when it's not losing money during those times, it actually has very good returns. As far as I can tell, there's only 3 years below a 10% annualized rate of return, 4 years if you count 2002, out of the last 20 below a 10% return on invested capital, which is actually really, really good, especially because that includes your years of losses here. And the years you're not making losses, you do really well with your return on invested capital, 15% 2018, 13% 2019, 49% 2020, and 88% 2021. Over the last couple of years, it has just absolutely exploded. It looks like they've been a huge beneficiary of COVID and some online selling that has happened during that time. So one big question would be is how sustainable is the recent returns? And that would be what I would want to know. But otherwise, this is telling me this is a high quality company. They're getting very good returns. Any type of marketplace businesses where they are receiving fees for the work of other people, whether they're users, they're buyers, and sellers, can actually be a really, really good business. And so you see that with these high gross profit margins, 78% gross profit margins, 24% free cash flow margins, 25% EBIT margins. A lot of companies have 25% as a gross profit margin. Having this as their operating profit margin is actually a really, really good number. Just something to think about how this business is operating. So let's look at the key statistics now. Again, these return on invested capital numbers are really, really good. 12% plus is a great number. I'm looking for 10% plus for most of my companies. You hit that easily. Even though they only have a little bit of leverage on this business at $3 billion of debt, they're translating a 12% return on invested capital into a 24% return on equity, which is absolutely plenty. You don't need much more than that to be very, very successful. Now, where we get into trouble with this business is when you start thinking about whatever this PE ratio means. Something is completely off with this number, 890. I don't believe this is a real number because when you look at a price to book at 5 and price to sales at 2, these are much more reasonable numbers. So it's telling me the stock's a lot cheaper than what this looks like on a 900 PE here. So we're going to have to dive in a little bit deeper to understand what's going on with this number and see if it's really real and what's going on. The revenue CAGR, it's telling me it's negative, but that doesn't look to be telling me the whole story. In 2012, you had $14 billion in revenue. You dropped 41% in 2013. It's not completely clear what that is. Maybe this is the PayPal spinoff. We're going to have to take a deep look at see if this is when PayPal was spun off, and see if there's a spinoff taking place here because this is a significant drop in revenue. And your EPS growth is 23%. So something's really strange happening there. I mean, you look at this EPS. You went from $2 in earnings per share in 2012 to $20 in earnings per share in 2021. This is astronomical. Very, very good returns. Even in the returns in 2020, if you just went there, I mean, your 3x, 2 to 3x within a decade is very, very good. You're liking what you're seeing there, and it looks like they initiated a dividend in 2019, so they're starting to return some capital to shareholders. Through this whole period, though, you see really, really good returns on equity. I mean, 204% in the most recent year, 176%. Astronomical numbers. Just really amazing. There's not been a lot of change here in the gross profit, though, across the decade. I mean, you started at $6.7 billion in 2013, $7.7 billion in 2021. It's not a lot of growth. It really isn't growing that much. It looks like this is a relatively stable business at the top line and even on the bottom line. So we're not seeing that much growth. And it's always a trouble. I mean, we're going to have to look to see what this profit number is. I mean, based upon this $20 number, I mean, you're trading at a PE of 2.5, which is crazy. Based upon a PE here of 8, you're trading at a PE of 5.5, which is still really cheap. Based upon a earnings of $2, you're trading at PE of 22. So the company looks like it might be really cheap depending upon what number it is. So if 2021 is a real number, which I don't expect, then you're astronomically cheap. If 2020 is a real number, then that's really good. And if 2019 is a real number, then you're maybe on the little bit of a high end side, but it's not unheard of for a business of this quality. But in general, if your revenue is truly flat and you're not growing, it's really hard because there's not a big difference between a return on equity company of a 10% versus 24% if there's no revenue growth, because the revenue growth is what allows shareholders to get a return close to the return on equity. If you don't have revenue growth, then the return on equity is almost irrelevant, because really what they're doing is they should just be sending as much money as they can back to shareholders because they can't grow. There's no way to reinvest that capital. If you're enjoying this video so far, hit that like button. Don't forget to subscribe. Ring the bell so you get notified as I upload new videos each and every week. We are covering in-depth company content. We're also starting to introduce some educational content as well, covering just investing and financial topics, and I hope you will join the channel. Let's look at the income statement. Yeah, big drop here. I want to skip ahead to the balance sheet because I want to see about a spinoff or something that I believe took place. PP&E, is there a big drop here? I don't see it. I don't see it here. It's not obvious that they spun off when they spun off PayPal, but basically eBay used to own PayPal and vice versa. So these numbers could be what's going on here. It's really hard to tell. I basically need to ignore 2012 because if I use 2012's numbers, then it just makes everything very complicated. One thing I want to show is so this year that you had really low numbers in 2014, we go back here in 2014, is fake because you see this, you have this income tax number, which was huge, and that's just basically completely wiping out your pre-tax income. But that's kind of a one-time number there. In addition, the loss here in 2017 is also fake on an operating basis. You had operating profit every year for 10 years. Every year for 10 years. So the numbers here are being distorted. These are distorted due to the Tax Cuts and Jobs Act. 2017 Tax Cuts and Jobs Act was enacted. It messed up income taxes around that year. And so here you could see a big one-time tax gain in 2016, one-time tax loss in 2017. These basically offset, but it makes it look crazy on a mark-to-market basis here. Now, something really strange happened in 2021 because you can see their operating profit of $2.9 billion, but they reported a profit here of $13.6 billion on the net income line. What happened there? It's almost as if that was something they sold. There was some weird other here. So these two big other line items are really distorting your net income and should be ultimately ignored. because it's not part of the operating basis, I would ignore these numbers and you're not actually getting that good of a number. So what is a better number? Let's call it this 2.9 billion or this trailing 12 month. Even that one's not the right number to use. What's the right number to use? Let's take this 2.9 billion. So how many shares do you have outstanding? You see you have 2.9 billion here. Let's say you spent, a couple hundred, 2.5 billion. So this is going to be let's call it $4 a share is maybe the right math here. So you're earning $4 a share, which on a close with maybe 11 PE, 12 PE, 11, 12 PE. This company's pretty cheap. I mean, it's pretty cheap at those prices, 10, 11 PE on a sustainable earnings basis. That's not a bad price to get for a company like this. Especially you can see these massive buybacks in shares. They start out with 1.3 billion in shares. They've cut the shares in half in a decade. That's a significant achievement. To buy back half your shares in a decade is very, very good. You really like to see that. I mean, look at these massive buybacks, 6.9 billion in buybacks, 5 billion in buybacks. I mean, they're buying back substantially more than their cash flow from operations. It's basically like a leveraged buyout here of the company. But that's really impressive in how much of the share count they've been managed to destroy in that time period. So I really like what I see there, in terms of being able to take that out of the business. What did they do with debt? Did they bring up the debt? So their debt did come up to 7 billion. They 4x their debt. It really is not obvious what happened here, just based on these numbers. I would encourage you, if you like what you're hearing with this business, you need to study in more depth what's going on some of the 10Ks. I would read the last 2 or 3 10Ks to get a better idea of what's going on with the business strategy, because the numbers here are telling multiple conflicting stories. In general, the numbers here look good, but you think about these cash flow from operations numbers. This is what matters. They're not spending a ton of it on your PP&E. It's really going into different things like investments, buybacks, dividends. You have a lot of free cash flow in this business, and it doesn't look like they're using a lot of it to grow, which is pretty good for you as a shareholder. But ignore these big jumps in numbers. Ignore this 2016 number. Those aren't real. These 13, 15% returns are a lot more accurate. But again, you're turning a 13% return on equity into 24% return, or 13% return on invested capital, 24% return on equity. Those are real numbers. A lot of the business is going to matter about the growth. So if this company is growing in the future, it's extremely cheap. If the company is not growing in the future, it's fair valued. And that's really what you need to think about. However, the very big positive in eBay's favor is the buybacks. So they bought back half their shares in a decade, which means that they added 7% per year to the EPS growth than you otherwise would have. That's really, really good. It basically means that they've turned to $2 in earnings per share into $4 earnings per share simply through buybacks without growth. Now, you'd like to have growth, but you need to make a judge for yourself for what the future looks like on that business. Again, if you have growth, super cheap. If you don't have growth, it's probably fair valued, and you're getting your return primarily from dividends and buybacks and not from growing the business. So for me, it's not going to go on my watch list because I really like to see more revenue growth in this, but I think it's a really interesting company. You have a lot of free cash flow. These marketplace businesses are very, very strong networking effects, and so it can give you a strong moat, and it's also just a nice place to own on a business where you have a two-sided network. They're doing all the work for you. You just have to maintain the network and do some advertising and stuff like that. So you enjoyed this video? Hit that like button. Don't forget to subscribe. Ring that bell. If you like this tool, it is quickfs.net. You can sign up through my affiliate link. It's the first link in the description below, and I can receive a commission if you get a free or paid account. Doesn't cost you any extra to use my link. It's just a way that you can support the channel. So thank you for listening, and until next time, stop paying fees, start building wealth.